All right, good afternoon, everybody. This is Event Trader, about to be joined by Brett Manning, chart trader. Of course, Brett, you with us?
Yep, how you doing, Gav?
I'm doing good. I'm doing good. How's your day going?
Pretty good. Pretty good. How about you?
Not too bad. Put some money to work today. We could talk about the trades in a little bit, but I took an investment size piece in Germany, the ETF, the EWG. Just like the way
Cool.
that that's working, and it's just such a beaten down area. Now we're seeing
Is
over
this a
70.
fiscal stimulus bet?
It is a fiscal stimulus bet, and I think that some of the reactions that we were seeing this morning to the ECB budget or to the different euro area budgets, where it seems like four or five of them are going over the fiscal limitations that have been put into place. I just find that the EU has a good chance of loosening up some of these in order to drum up support. Was intrigued by Madame Lagarde's 60 Minutes interview. I didn't think it really brought anything new to the table, but just her noting that they're not at the lowest level of rates, but certainly it hinted that there wasn't a lot of room left to do anything there. So we know Germany's been kind of pushing against things so much on that front, on the monetary policy front and the fiscal front, but I see them breaking a little bit on the fiscal front. So yeah, we could call that a fiscal stimulus bet there. Return on some of the beaten down auto sectors, some improving global trade dynamics there, and possibly a turnaround in China, which is its largest trading partner. So all of those things were kind of at play for me there. The other was a FedEx swing long, which I just think that we could see a continued bounce in this. I thought the reaction in UPS following their earnings results, which weren't great, but one of the things that I'm seeing, and we'll talk a little bit more about this, is linearity comments from these transports where they seem to be seeing an improvement in September and certainly into October from that slowdown in July and August. So that's kind of been key for me, and looking for a bounce back in FedEx in the final quarter of the year. And then the other one was just Peloton, which I think I might have been a little too early on. I'm going to continue to watch it, but there's some of the actions that I was taking today. So I don't know. Is there anything you're eyeing up right now at the moment?
I'm firmly in research mode. I'm working on the new chart book, and generally speaking, the first major week of earnings season is not something that I believe is a top-down market trading opportunity. Basically, the market is an aggregate of lots of individual micro inputs rather than something that has a top-down character to it. So the pattern analysis and sentiment data even on a short time frame is really more or less useless during this week. So it's a time that I take to try to come up with a strategy and approach for when we start to get into a more macro-driven market.
Okay, and obviously I'm on doing this, but just as a heads up, breaking news, that second vote that I just mentioned, that Piers Johnson did lose that one. This was also
Program vote,
expected.
right?
Uh, yeah, in terms of the length of the turnaround for when the final vote would be for Brexit. So basically, we had the first vote, which was expected to pass by a slim margin. It's actually passed by a better margin than I expected. The
Doesn't this mean they have to ask for an extension now, though, right?
More than
They
likely,
have to.
there's also talks about they could go back with a second vote on the length of the debate, but obviously it looks like there's more that. So basically, what they are talking about is debating the final bill. They agreed that they'd move on with Brexit, but there's still some loopholes that will allow members to tack on riders. There was concern that there could be some unpalatable things that would be tacked onto this, and if that was the case, then the final vote for Brexit would fail. And
Right.
what this second vote was for how long they would debate this portion of the bill process, and they put forward three, which was very unlikely to pass. They're going to want at least 2 weeks on this, so I think we could see, in all likelihood, the idea that they will go back and look for postponement by the
Yeah,
EU. I think it's likely that the EU would kick this down the road to January 31 seems to be the most
certainly.
agreed upon date. Brett, I don't know if you've got anything to add on to this at all, or any,
No.
or if I missed anything of importance.
I mean, the only question would be if there's something, dramatic sidestepping strategy by the government. But I think, it just seems like it's inevitable at this point that this is going to end up managing to squeak by and get down, get to the next extension, and then we'll see.
Right, and with
Then the
that,
narrative can change again completely.
well, with that sidestepping, Brett, the discussion is that they could call for a second vote,
Okay.
for a second election vote.
Election, yeah, I was going to say, right, exactly. That's been the
So,
threat.
but I mean, getting some developments there at least, shaking the fruit from the trees, if you will. So we'll see if this could continue to gain steam. But I know from my point of view, I'd like to see him pull the Band-Aid, Brett. I don't know how you feel on this whole process, but I assume that you are
You
in the
certainly
same
can't go
vein.
back. You
Yeah,
can't go back. So once you know you can't go back, then, you might as well go forward.
right. Exactly. So, all right. So let's take a look at everything, Brett. Just a quick recap from last week. We talked a lot about the positioning we last couple of weeks and how everybody was set up, particularly just going off the put call ratio, for something negative. We are seeing that shaken up a little bit, and we'll get into some of the sentiment trader readings here. That obviously is boding well for the markets. We're seeing the S&P still can't find a definitive bid above that 3,000 level, but it is holding it a lot better. One would think. We really haven't had any negative headlines crossing the wires particularly on trade. Incremental developments, I would say, on the whatchamacallit, on the impeachment front. But has there been any marked movements on the macros since we last talked in your eyes?
You mean a change in the context?
Yeah, changing the narrative from when we were last talking.
Yes, I think that, well, I don't know if it's really a change from last Tuesday, but I think that it's more of a solidification in my mind that we are seeing a symbolic movement by the White House to signal to markets that it doesn't, it really wants this trade war theme to not be an impediment to leading indicators between now and the election. And, that we'll find ways to make that picture fit together. And I guess we did talk about this last time, because then it really does come down to whether or not China's going to participate. I think that's a more important factor, particularly for U.S. risk assets than the Brexit conundrum, which I think markets are kind of. I don't know how much of a difference that's really going to make, for instance, in the S&P, whether that's resolved or not tomorrow. But I think that certainly whether or not the White House is going to move toward what I would consider to be almost another policy lever, right? I mean, if you think about it, the impact that we're seeing from the sort of rhetorical context around the trade war between U.S. officials and Chinese officials, and whether or not that's being sort of amplified or exacerbated versus being kind of put in more sort of a copacetic kind of glide path, which we've seen over the last couple of weeks, is something that I think has a direct impact on what you see for, let's say, like manufacturing sentiment data, leading indicators like that, in terms of how people are willing to take risks and invest, because we're seeing a lot of the economy hold up well, retail sales, labor market, housing, et cetera. And so there's an underlying demand for things that still persists, and whether or not people are willing to meet that by investing in developing future inventories and really packing the supply chain to feed into that in the future, the question, that's a risk that anybody would take at any given time. And if they feel like things are deteriorating and the decoupling between the world's two biggest economies is accelerating to a degree that it's going to become really sort of death to the cycle, then they've been reluctant to make the same level of investments and spending to develop that, pack the supply chain. And I think that the White House has the ability, if it's aware of all of those relationships, which I think it probably is, to impact those leading indicators relatively directly by signaling, whether or not we're really on a glide path towards something. But as we talked about last week, China could get into the mix and disturb that narrative. But I think we're continuing to see an effort in that direction. And did you see the Richmond Manufacturing Index? The comment I made earlier
Um,
today?
I did not. I didn't see your comment. I was paying a little bit of attention to it, but
Was, I
what
mean,
did it do?
huge beat, right? It was the
Yeah,
first manufacturing sentiment data point we've seen with a big beat, and new orders were like massively above what we saw last month. So I know that that's only like 6 or 7 states in the sort of Atlantic coast, but it's still I mean it was just interesting because it stands out so much when you put it in the context of what we saw in that in that big ISM data point from a couple weeks ago.
yeah, and it's funny because in the sentiment and data, we're still seeing soft versus hard data in the pessimism side of things, but we're definitely getting a switch on that. So. And also, but sorry, just watching the markets here is the second Brexit vote. Trying to throw up a quick comment for people on the site as well too. But yeah, just to repeat, the second Brexit vote did not pass, and as we were talking about, that was also expected. And we'll see where this comes into play now for the markets as they try to debate where how long of a time frame they'll talk about the current bill in. So, but Brett, to circle back there, you were also talking about the administration. I think two other things of importance too that played out to show that the administration was a little bit more willing to play ball, if you will, was Trump backing away from the Doral G7 meeting as that being the location, as well as kind of pulling back a little bit on the Syria withdrawal as he's moved troops over there. So it certainly looks like the Trump administration is looking to play out and, you know, play a little bit more by the rules, if you will, going into those 2020 elections. Certainly getting
Really?
The GOP onto their side.
That's all right.
What
I don't see that. I don't see that. But okay.
you don't see that?
I don't see that as being likely what the symbolic importance of those actions is. I think that probably that campaign is going to be one that once again tries to draw its strength from, bucking the establishment as much as possible. But and yeah, I will agree that the pullback on the Doral location was, I think it was like the Q in the sequence A B C D E Q. Like it just doesn't fit with anything else that we're seeing, and so it does stand out to me. But I really I can't imagine it as a sign of a more centrist Trumpism emerging
I'm
into the
not sure as
election.
much as centrist as much as just trying to get the GOP on his side ahead of these impeachment trials. I mean, I don't think that there's much of a risk that we would see the Senate vote for it, but one item of interest Carmine had sent to me was that even the House, they're actually losing some votes from GOP members on this impeachment process. They still have the votes to pass it, I believe, but it's causing them to delay it until December. So I don't know. From that perspective, it seemed to me some of the news that we're seeing certainly was a little bit more in focus and a little bit more along the lines of, appeasing the GOP at the very least. Certainly not the left, and certainly not the Democrats. We've certainly seen him continue to push on us versus them on that front, but it just kind of goes to what you were talking about with the Chinese talks in terms of looking to be a little bit more willing to get deals done in order to strengthen his position going into 2020.
Yeah, absolutely.
Is how I look at it. So, okay. So with that, Brett, taking a look at some of the sentiment trader data, there wasn't a lot of big moves. One of the things that I did see was a little bit more of a push away from some of the pessimism that we had been seeing as of late into a little bit more optimism. And some of the things that were playing out here, we'll take a look at the more optimistic data points that we were seeing first, Brett. One was the SPY liquidity, which moved into optimistic territory here. Not complete extreme, but people moving out into individual stocks, of course. One of the big moves I saw was the move away from cash to put some more of that to work. That was a big drop in the sentiment survey. And then the other one was the New York Stock Exchange to high-low ratios, which a lot of companies moving off to lows, I would assume, in the energy space there. Did you see anything of note from the optimistic side of things from the
Yeah.
sentiment data?
Yes, so I mean, I think that all falls into line with the larger narrative. I'm seeing the same thing. So I mean, to frame it in the context, we basically we saw a number of different signals maybe 2 to 3 weeks ago that went into just extreme bearish pessimism territory, particularly on the option side of things. We saw just massive amount of protection come in, had a 10-day put call ratio that was just skyrocketing into the type of area where you get toward the bottom of a major bear trend, even though we'd only pulled back a couple days. And small traders options data, same thing. Lobo and Robo ratio, large only buy to open options put call ratio, and the Robo, which is the retail only buy to open options put call ratio. Both of them isolate opening trades for smaller, more retail accounts versus larger money managers. And the difference there is, generally speaking, the smaller guys are usually doing something that amounts to speculating, and the larger guys are usually doing something that amounts to hedging. But when they both line up, it tells you that the positioning is such that the market has a difficult time continuing in the direction that everybody's bets are placing on. And we got to the point a couple weeks ago, and right out of that ISM data, where we just had big extremes across pretty much every options ratio, and we've really pulled back into that neutral territory now. And I think that matches with the surveys, the AAII, the American Association of Individual Investors survey. We had the bull ratio was in pessimism bear territory last week when we talked, and now it's right back up into sort of neutral ground. There's really one data point that still kind of continues to show a sort of longer term impact of malpositioning. We will talk about cash flows probably too. So that's there. When you look at flows into from like prime broker data where funds are putting their money in which assets, it's still kind of a bit on the sidelines, and certainly not aggressively in equities by any stretch of the imagination. But another thing from the retail side that fits with that is we're seeing margin debt on NYSE way below where it typically is when the market's near all-time highs. And that just basically shows that people, particularly retail traders, aren't particularly leveraged, even those who are long the market right now. So it is just kind of bound up at a point where we're kind of still pessimistically positioned, and on a big breakout, you could see that leverage come in, particularly if that breakout is associated with some kind of advancing of the narrative in terms of Brexit or the trade war, or how earnings season progresses, or manufacturing supply chain data. Any of that stuff that accompanies a breakout, you're probably going to see that margin debt start to spring, and that could really fuel an extension to that type of breakout.
Yeah, I mean, that would be something that would definitely get us going for sure. Taking a look then, Brett, on some of the pessimistic side of things. We still got that soft versus hard data, but starting to see a turn in that, it feels like. You mentioned the Richmond Fed. We had the Michigan sentiment last week, a little bit better from Empire as well, too. So that seems to be working its way into play. That small trader put buy continues to hold into that pessimistic side. People obviously looking for downside protection. Lobo and Robo calls, they are neutral at the moment, but and the inverse ETFs also, they've reversed a little bit more into the middle. So it does seem like to a certain degree people are pulling back from some of the pessimistic trades that they're making. So I don't know if you got anything to add to that. Brett, did I lose you?
Oh, sorry about that, Gab. I had it
Were you
on
on mute?
extended mute. No, I think you hit
Yeah.
the nail on the head. Yeah.
Okay. Yeah. So, I see that as a sentiment. So, all in all, just kind of pulling back and taking a look at that, I think it continues to fall into the category that we've been talking about for months, where people are just under leveraged and perhaps over overprotected here that really could build up if we continue to see these headlines trend and we continue to see a repeat of the first week of earnings in this week of earnings season. Then that's really going to clear the path for a lot of the concerns that we have moving forward, and kind of set up for a Q4 potential rally. And with that in mind, I kind of wanted to point out, Brett, bring in one of our own in-house pieces here, and that's Pat O'Hare's big picture. I don't know if you had a chance to read it from last Friday at all, Brett, but the one, Why It Can Pay to Think Like Wayne Gretzky Skated.
I did. Yeah, right. Skate where it's going, not where it is.
Right. So I guess the question for you that I have is really based around the Sir John Templeton observation of bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. And one of the things that Pat postulated in this is trying to figure out where we stand in this process. So I'd be curious as to your thought on the bull market, which I guess we go back all the way to 2009 on this. Where do you think we stand on this, or do you think that there was a reset in the middle that perhaps since we got so beaten up, nobody really kind of took into consideration as the reset for a new bull market?
Yeah,
And by that, just to clarify, to make sure we're on the same page, meaning we got so beat up that did we skip off the idea of a corrective bull market?
well, when?
Well, from 2007 through until March 9th of 2009, that the selling was so intense. Is it possible that we kind of sold off to such a degree that in the midst of this current bull market that most people would date back to March 2009,
Sure.
did we run into a hidden bear market?
Yes.
And in that case, where do you think we stand in this? When was that? And where do you think we stand in the Sir John Templeton landscape of a bull market?
Yeah, so I think we unquestionably got to the level of risk aversion and even a disintegration of half of the economy during essentially very late 2014 through early 2016. And that's when we saw interest rates get well down to negative for the first time around the world, and to this sort of 1.5% on the 10-year that we saw. And that's where we saw this initial version of this process that I've talked about, where you get what I call the refugees from the fixed income markets to come in and start buying equities when the dividend yield on the S&P rises on average well above the 10-year. And so you get kind of a high floor to the market. So even though you see something like an enormous string of bankruptcies in energies and commodity producers that we saw in late 2015 and early 2016, virtually all major commodity markets in severe bear markets, and a massive drop in interest rates to test all-time lows. And I guess around the world, some people tried to come up with a system to understand that it was the lowest interest rates in 5,000 years on a global basis. And that's the midst of what looks like nothing when you look at the S&P chart. And some of the sentiment data that we saw during that period was as bad as you'll ever see. We came into the Brexit vote with, I remember seeing one statistic showing out of a survey of I think 230 different very large money managers, there were only 2 that were overweight equities. And you only see that at just tremendous bearish extremes. And we saw across the board in terms of options data, surveys, everything kind of reflected the same sort of deep bear market kind of sentiment context, and yet the stock market hadn't really corrected very far. So it's exactly like what you're saying. I think that that was sort of a stealth bear market and a stealth cyclical reset. But the closest that we got to exuberance in front of it really wasn't full out exuberance. We saw some we had I think a 30-year high in the Investors Intelligence newsletter gauge, and There was one other data point, I can't remember what it was now, that was in like a 20 or 30 year high kind of territory. But it wasn't a confluence of a lot of different sentiment indicators that showed huge bullishness. But we did see something like that, curiously, in early 2018 after the tax reform bill passed. And that was really the closest that we've gotten, I think, in this entire cycle to what I would call true exuberance. Even though we've seen higher market prices since then, we did reach some multi-decade kind of extremes in terms of bullish fervor and enthusiasm. But there's been pockets of that since 2009. But this whole cycle has been, I think, if you want to take a 30,000-foot view, this whole cycle has been a really slow burn. So it's the longest cycle ever, and we've seen huge reaction in asset prices. But as far as anything that would show what I would call like a thawing, every bull market you can think of as something like, the intermission between ice ages, and it's a global thaw in terms of how people interact with asset markets. And interest rates are the best example of that ice. And interest rates have barely been able to get off the ground except for a couple different moments and for very short-lived periods. So we've had a long, slow burn. And I think if you think of the cycle like a wood pile sitting next to a fireplace, you can burn it all right away by jamming it all in and throwing some lighter fluid on it and throwing a match in. You can have a short, powerful cycle where interest rates really heat up. The Fed has to deal with inflation. They immediately raise interest rates and you kill the cycle. We've had short cycles like that in the past, but this one has been like putting just a little tiny bit of wood in at a time over a long period of time, just keeping it sort of smoking and simmering in there. And it can go on like that for a long time. And I don't think that we have really seen that wood pile, combust. We haven't really seen that side of things, really get going at all. So as far as the John Templeton framework, I don't think we've really seen something that I would consider to be the type of exuberance that, if you think about the Turtle Beach metaphor, really means all the turtles are sitting out of their shells with their necks stretched out in the sun waiting to be killed by something. There's not a lot of pure, unadulterated mass risk acceptance across financial market participants, banks in terms of their lending, corporations in terms of inventory stocking and hiring, and individuals in terms of just, wildly building up debt for frivolous spending. Like, we haven't seen that whole cyclical process of people leaning way out over their skis too much because there's been so much, and I think part of it is there's been so much constantly in the headlines defining this cycle that just gives you the feeling that, somewhere there's something awful happening. There's just this sense of a lot of big and difficult traumas and troubles that are happening. And geopolitics has probably been a big part of that. And it's probably kept people from really feeling that sense of exuberance that we saw, for instance, in the late 1990s.
Yeah, sounds to me like you're trying to quell up the press here, Brett. Only kid. Hey, real quick, while we're talking here, S&P down to test that 3,000 level. You got any thoughts on this move here in the indices? I know you've been looking for a little bit of a pullback shakeout.
I believe there's something much. Yeah,
I know much bigger on scale than a 12-point move. Obviously, given how tight we were trading in the afternoon, this move seems a little bit more embellished than it really is, but.
I would like to see a break under 29.70 and buy into it.
Yeah, because you said...
I'd like to see it be headline-driven.
And this, I would argue, is certainly... Well, would you view this as headline-driven with the Brexit headlines? Or
I suppose.
Yeah.
I mean, I feel like there's still a quick twitch bear trigger where people are maybe... There's people out there who've kind of gone, oh, man, the market's not cooperating with me on the short side, and they've pulling back, and the second you get a negative headline, a little downtick, then they come in piling in to try and do that. So I'd like to see that build up. I'd like to see something a little more dramatic, some questions maybe about whether or not in November we're going to get phase one of the trade deal.
Maybe an Instagram post of President Trump with Winnie the Pooh.
Hey, there you go.
There you go. Get a big shakeout on that.
Randy
right?
Marsh. Yeah, right.
But you get the Winnie the Pooh reference, right?
Absolutely.
Yeah, okay. For those who didn't know, Winnie the Pooh was banned in China because people were saying that Xi looked like him. So Winnie the Pooh is no longer allowed in China. Brilliant South Park episode there, right, Brett?
Absolutely.
But, okay, so... All right, so we talked about where we kind of think we stand in the cycle, and that the fact that, and we've been talking about this for weeks, that there is that blow-off euphoria type. And one of the reasons why I was looking to add some positions here as we keep going through earnings season. Um, Let me ask you this, Brett. One of the things that I wanted to take a look at, I don't know if I'm going to be able to pull the chart up here, but copper. I found it to be pretty interesting because I hadn't looked at it in a while, and I was looking. I was doing the Freeport McMoran earnings preview, and obviously, if you're doing that, you got to keep an eye on gold and copper prices. You've been all over the gold trades. You've done pretty well in it for yourself. So I'm curious as to what your thoughts are on copper, and then we're going to just kind of take that as the read through for the global economy um, moving forward. And obviously, we could couple in yields, which have also been on the rise. But I asked you earlier if we could discuss this, and I don't know if you had a chance to take a look at it or any of the chart
Mm-hmm.
formations at all. But what I was just going off the continuous, the high grade copper
Yeah.
symbol HG. And I found it interesting that I was just kind of edging up into this, into its 200 moving average weekly, which I got sitting right at 263. Now,
Mm-hmm.
what was driving me of interest here was obviously we know the demand has been weak. All you have to do is look at Freeport McMoran stock to see what the weakness that we've been seeing in demand in copper, and that's also, of course, weighing in on the metal itself too. Obviously, a great read through for the economy. But one of the things I found interesting was better than expected trade talks. Obviously, that could help build
Mm-hmm.
the potential for fiscal stimulus for industrial products. That
Check.
stands there. So the demand potential is there, but then when you start working into the supply, and a lot of these miners, if you've been on the calls and you've been looking around, you can see they've been really cutting back on their capex and have under invested
Mm-hmm.
over the last 2 years now.
Yep.
And the second thing is the supply side. On top of that supply side, Chile is starting to see mounting protests in its country. And we got a strike going on in one of its mines, and Peru, also one of the leading copper producers, has its second largest mine, which is 17% of the company's production or the country's production, and 2% of global production shut off by protesters that are blocking the roads for deliveries. So now you got a supply issue, you got a possible demand issue coming into play, and that's one of the reasons why I liked Freeport McMoran here. But you got any thoughts on copper? I know you've traded it in the past, Brett, but you thinking of you have any interest in anything here?
So I think that it is a central asset when you're looking at one of the things that we talked about last week. And we got to the point where we said, okay, this is the biggest price action vulnerability to the markets in terms of positioning, which again doesn't mean that it's going to equal a price move. It just means that if certain things were to happen, then this would be the largest response. So, and that equation is if we were to see inflationary growth, then people are the worst positioned for that. Right? Doesn't mean there's going to be inflationary growth, but if we start to see inflationary growth, then I'm going to lay out a scenario where we could, and then, think about warning signs. But copper would be massively implied there, right? From
Right.
short bonds, long copper would be the thing you do in a shift from a sentiment context where no one's at all positioned for inflationary growth, and then you start to see inflationary growth. That would be short bonds, long copper. And the dynamic would be something that's kind of written into everything you just said. People aren't positioned for it, not just in financial markets, but just like you said, in terms of production, right? I mean, it's just nobody is positioned for the idea that suddenly demand for copper could go up a lot. People have not built that into the model as far as somebody like FCX, for instance, or other producers or other mines. It's not being managed from the standpoint that they've got to get ready for a big increase in demand because, of course, we've got the trade war and we've got deteriorating industrial data and manufacturing data. So, that's built into the equation. And how we could get there. Here's the speculative fiction version of the future that would contain that shift, and that would be because, like we said earlier, there are aspects of the economy, particularly in the U.S., that are holding up well Retail sales, housing, consumer confidence has surged. Employment has been really steady. So there's the idea that there's still M2. I don't know if you ever look at M2. It's been spiking up.
Yeah.
So there's active lending like crazy. There's people are confident in their nest eggs, and they're confident as consumers. They're confident in keeping their jobs, and they're spending money at stores. So that's all still happening. But there's a speculative fear among people managing supply chains and industrial chains, and concerned about demand falling off a cliff. And so they have been wary, just like we talked about earlier, to expand investments and expand operations, and to invest more in, let's say, new copper mines, because that seems like a kind of difficult investment to make at this point if you're not expecting inflationary growth. So that's there, and if we see let's say we see a period from now until the presidential election in November of next year where the White House really makes a strong move to try to help leading indicators surge as part of trying to really cement into place confidence on the economy as part of this, and uses its rhetoric and the whole narrative path for the trade war to be part of that. And so maybe we even see in the speculative fiction version of reality that the White House finds an excuse to actually reduce tariffs with China and start to make it look like they're really making an effort toward sealing this thing up. But obviously those phase 2 negotiations will probably happen after November of next year. We can imagine that being pushed back, but still the process allows them to reduce tariffs. And maybe that's not going to happen, but if it did, you could see how we would start to see people who have been underinvesting in, let's say, copper production or all sorts of things, when you're talking about logistics, supply chain, industrial side of the economy, when they realize the rest of the economy's been holding up, and now that fear starts to recede, and you suddenly have the possibility of what you might see as kind of like a pent-up business investment wave because they've been under-positioning there, so then there's a surge in that direction. All of this would lead to something like copper performing extremely well out of an environment like that. And the other variable to throw into this whole narrative is the fact that right now we see, I think, the biggest. Let me look at a larger time frame, but I think it is right now. It is the biggest ever, or very close to the biggest ever, net short position by large speculators in copper.
Really?
So yeah, or we're very close. We were at a level in August that was slightly more so, but we're back down very close to that right now in terms of large speculators.
So even
short
the positioning in copper's Kindle.
Yeah, short 47,000 net contracts right now, and that's that we were short. Oh, it's 58,000 in August, but I think that we got close to that in 2016, short 44,000, and close to that in 2015. Short 41,000, but I mean, it's been years and years and years where we've seen a short position anywhere, like this. It's rare that we get anywhere near here, and this is, apart from August, the biggest ever short position. So if you start to see some of those factors come into play, and that's just, of course, that just makes sense with everything else I just said. The one thing people aren't positioned for is a world where interest rates in copper are rising because of inflationary growth in terms of estimates. We saw in that last fund manager survey, this only 4% of fund managers thought they'd see higher inflation a year from now.
Yeah.
So, I mean, it's 96% don't.
All the sentiment surveys roll out from that too.
Now, again, that's because things look so unlikely to happen in that direction. And that, maybe that's right. Maybe the world is shaped where it's impossible for that to happen, and that's why everybody's so sure it won't. But again, that's the vulnerability. And if we do start to see a shift in the environment, that's the thing to look out for. So you do this if-then game, and it's one of the things that I do. It's one of the things that help fuel that big gold trade, where you start to look at what people aren't positioned for. You see it as a vulnerability, and then the moment you start to see any hints in that direction, it's where you have to go. It's the first thing on the list to do when you start to see, there's signs of something moving in that direction, and that could be rhetorical out of the White House. That could be in, coming data that we start to see in terms of leading indicators on manufacturing. There's all sorts of ways in which that could start to peek its head up a little bit. That there's some life coming to that side of the equation, and you're going to see that 4% move to 25%. It doesn't have to turn into massive inflationary growth boom, but just that repositioning of those other 21% of money managers who suddenly have to shift assets around to account for that possibility of rising inflation and growth. That moves asset markets, and asset markets are really responding to those sorts of shifts, no matter what the final outcome is.
All right. No, it's good stuff. We'll have to put together a basket of plays on that, Brett. What do you think of that? That'd be a good thing to maybe
I think it's a
introduce
good
to.
thing to have in mind. Yeah, a quick reference to just say, if we
Maybe we'll
start to see
set that up
signals,
for the next
here's where the
sentiment and flow show or something.
here's where the action is.
The
Yeah,
leaning
and if
wrong
then,
basket.
yeah, I mean, yeah, right. I think that's a great the leaning wrong asset basket.
There you go.
When everybody's leaning on something, when there's a consensus formed around any idea, then yeah, it's imperative to understand what sorts of opportunities there would be if that consensus idea is wrong. It doesn't mean that's the investment to make. It just means understand that, so that if you start to see, wait, everybody's going to be wrong here, you know very quickly how to implement and execute.
All right, Brett. Well, I'll tell you what then. I'll is there anything you have to add? The last thing I was going to throw at you was just your early takes on earnings season. If we're missing any important points that you want to discuss, feel free to jump out there. But you obviously like the first 2 weeks of earnings season to play out. And if anybody was to look at a chart here, you could see exactly what Brett is looking at. The amount of times where you see that reversal from the initial week in earnings season is breathtaking. So the overall trend definitely tends to take a little bit longer to play out. But is there any thing that's been sticking out to you from this early earnings season?
No, I mean, I think of it like polling. For like, there's a sample size issue, and at a certain point, an earnings season gets to a certain level of critical mass, a threshold of polling results where we get a sense of the narrative identity of that earnings season in the grand context of things. Um, at this point, I mean, you would have a better idea than I would what the narrative context is going to turn into, but it's too early, right? I mean, we've
Yeah.
got so much headed for us over the next just 6 or 7 days, even, where we probably start to get to you, just like when you think about when election results come in and you see, at the beginning it's 80-20, and then it's 60-40, and then it's 75-25, and then at a certain point you get to a certain critical mass in like some county vote or something where it's like 53-47, and every new vote that comes in isn't really going to move the needle much, and you kind of you call the results. And about 2 weeks into earnings season seems to be about that point for me to get a sense of what the identity of this earnings season is going to be in terms of its impact from a top-down perspective on global asset markets. And I think, again, you are usually my source of perspective there. As we start to get close to that 2 weeks, I usually start talking to you and saying, hey, Gavin, what do you think the basic gist of this earnings season is?
Well, I think that was evident probably in my moves today with that FedEx position in EWG. I've been pretty impressed so far. It's. I suppose you could argue that this is the same story every earnings season, where everybody lowers their expectations so much that when they beat them, everyone's like, "Hey, that's fantastic." But
Yeah, until it doesn't happen that way, and then that's the end.
but yeah, exactly. But the thing that and that's when you have the bad earnings season, right? I mean,
That's the end, though, right? I mean, that's when it's just, oh gosh, everything's changed.
yeah.
And that's usually the one that introduces the real new version of the cycle.
Exactly, and I don't see an introduction to that, and
Right.
really broad based too. I mean, the commentary, you know me, Brett. I love following the banks just because you get a pretty fair idea of demand out there, and they were all pretty upbeat, and that's in a difficult environment. The other thing that
You're capable of it. Gavin, folks, he understands. Banks are notoriously difficult to understand around earnings. And Gavin's been doing it for a long time, and when he says it's more impressive than you think, then that means that's true on a deep level.
Yeah, I appreciate that. But but also not just them. Some of the commentary we've seen from the semis, and this you could date this back to the Micron a couple of weeks ago, where they're seeing an improving demand environment and inventory. Most importantly, seems
And that's
to
a
be
very
clear.
separate cycle, right? I mean, that really is a very separate cycle.
It is.
Yeah,
But
and it's important
inventory's
that it
been
folds in right.
but inventory's been cleared out. And then when we take a look
Mhm.
at the transports, not great results, but what you got to look for on this is we knew they weren't going to be good going in. It's the linearity comments that have been sticking out to me with the CSXs of the world, the JB Hunts, and the Kansas City Southerns. And what I mean by linearity is, okay, you did that in July, you did that in August, and you did that in September, and you're seeing this in October.
Sequential.
Sequential, exactly. And that commentary has been impressive. And then even overseas, Ericsson, SAP, another reason why I like the German logs, seeing much better than expected data from there. You can look at UBS. And a lot of these European institutions, Brett, I don't know if you follow the EUFN at all. That's
Yeah,
been acting really well and starting to see a bit of a turn there. Another reason why I liked that EWG play here. And I
that
know,
was a
Brett,
play off the 2017 French elections, as I recall.
yeah, exactly. But also it's kind of a play, and we got the ECB in a couple of days. I don't know how eventful it's going to be. It's going to be kind of a swan song for Mario Draghi as we
Yeah,
clear the path for Christine Lagarde. I don't know. Did you see the 60 Minutes piece with
I did
Lagarde?
not. I did not.
You didn't miss anything. She didn't really.
I
It would
figured
have been a
it was
lot.
central bank talk, right?
What's that?
It was central bank talk.
Yeah, basically. But I mean, the one thing they did ask her directly about the negative rates, and she was like, "I don't think we're at the bottom yet, but we are near." So, I
Okay.
think that's been kind
Which
of
tells you nothing. Yeah.
it tells you
Right.
nothing. Again, it wasn't much news. I am a big fan of her. I do think she holds herself well, and I do find that her taking over potentially is good for Europe. We'll see if the rest of the population there
I'd agree with
agrees.
that.
Yeah. But anyway, the bottom line is earnings season so far. Why you said small sample size, but I have been impressed with it, and I think that the reports certainly been hitting that better than expected, and even better than the expected, if that makes
Yep.
sense.
Well, that's
But
important.
so positive for the markets, and another thing that could really help us bubble up here going into the final quarter,
Yep.
barring any fall off from the trade talks in Chile, of course. That's kind of what makes it a little bit difficult
Well,
to go in full bore into euphoria here.
and let's just say um, it's not just about the fact, but it's how both sides want to frame the narrative around that. And that's going to be reality, I think. Really, it's going to be about what the larger agenda is, how to make this look, regardless of what it actually is. And that's for me right now. I think that I'm focused on the idea that the White House has an agenda around making it seem like less of something to be scared of, if you're a part of the U.S. economy, that there's going to be this dramatic escalation, and that there's going to be this tipping point in this, historic kind of decoupling between the world's two greatest economies at this point. Um, I think that, framing the narrative as, no, this is going to be fine, it's no big deal, is where they want to be right now. So whatever transpires, I think we're going to get information about what that narrative framing agenda is. But right now, that's my bias on that, and I think that that's probably more important than what actually transpires.
All right, Brett. Looks like we're getting some feedbacks on the leaning wrong basket. People very
People like
interested
it.
in this. So yeah, so we'll definitely put this together and introduce it in the coming weeks in our sentiment and flow show. All right, Brett. You want to wrap this up in a nice tidy bow for us here, or am I missing anything that you wanted to touch upon?
No, I mean, I think if you're just, we normally just stream through data point by data point on sentiment data, but at the beginning, the summary was really sufficient in this case because, all three major points in terms of options, in terms of positioning and flows, in terms of surveys, it's mushed back into neutral after being extreme in terms of, certainly where equities is concerned. But I think the big takeaway is similar to the takeaway maybe that we had last week, but certainly, emphasized more now. And I like your copper example as part of it there's there's if there's one major lean to things, one consensus idea about things that if it's violated would cause the greatest scrambling among asset markets, that is the idea that inflationary growth is impossible right now.
Yeah.
And I think probably playing into that is the notion of the sort of impotence of central banks in terms
Sure.
of traditional monetary policy tools.
They haven't been
And,
able
and
to
that,
inflate in 30 years now if you're taking the Bank of Japan in, right? So there's a good
yeah, I
reasonable
mean,
doubt there.
right. So it sort of makes it easy to hold that opinion. But that, when we get most major inflationary growth, the serious is not caused by central banks. Like it's a fire that catches, and central banks end up having to put it out. And they don't just push the whole time. I liken it to trying to start a lawnmower that has a ripcord. You pull it, or a chainsaw. You pull the cord, and then the engine catches.
Yeah.
And then it's going. And it's the engine, and eventually they have to hit the off button because the engine's going too much. And so the actual process of inflationary growth is not about central banks pumping things up. They're trying to start things. And I think it's easy for people to feel like they can bet against inflationary growth right now because central banks would appear in the narrative context that we live in right now to be sort of seen as impotent. But lo and behold, what's the last CPI number we saw? 2.4% year over year, above the Fed's target. And there's little cracks in that narrative. And if we see the right framing of the path forward for how the U.S.-China relationship is going to go at least over the next 12 months, because that's what we're talking about coming into the election, roughly. And we see people, in heavy industry and in supply chain and in logistics and on that side of the equation and in production of raw materials, all start to feel like they're behind the curve in terms of packing the supply chains and producing and delivering an inventory and managing to push things upstream. I think that there's that little possibility that could become a scramble because the rest of the economy isn't really faltering. So that's all in place. It could play out that direction. I think that like we talked about the leaning wrong basket. I think that's one of the most interesting takeaways from our discussion today is just to kind of have that on the radar as an important analytic piece of the puzzle that could offer up some really tremendous opportunities if things do tend to tip in a certain direction.
Right. And, this is all going to set up well for us next week. And what's shaping up to be a big week, we, of course, got the ECB on Thursday, but next week we got the Fed. Thursday, we got PCE data, which, as we know, Brett, is the Fed's baseline for following inflation.
Right.
Also, that day, the employment cost index is going to be out for Q3. And then Friday, little thing called the jobs report coming out. And that's not to mention the ISM manufacturing and all the PMI data. So, huge week next week. And a ton of earnings, too, including Apple. So, next 10 days or so in the markets, really going to be getting everybody positioned up ahead of that Chilean meeting between the President Xi and Trump. So some good stuff for us to look forward to. But Brett, I guess that's going to be it for us this week. We are recording this as per usual, so I'll be posting it to the site probably a little bit after the market closes.
You got it. Sounds good.
Take care, Brett. We'll talk to you soon.
Okay. Take care.